Okay, we're going to get going. Welcome, everyone. Thank you for taking the time to join us today to discuss the wonderful world of fixed income. And I have the distinct pleasure. I'm Brian Spinelli, Co-Chief Investment Officer of Halbert Hargrove, and I have the pleasure of introducing Ken Chambers, who is an Executive Vice President and Fixed Income Strategist for PIMCO. For those of you who aren't all that familiar with PIMCO, they're one of the largest global fixed income managers, and they are one of the partners HH uses in building diversified portfolios for our clients. A little bit background on Ken. He's an executive vice president, fixed income strategist. He is a CFA charter holder and has also got an MBA from the University of Chicago. So quite a few notable financial professionals have come out of that school. So he's one of them. And today, Ken's going to cover the fixed income markets predominantly from the active and passive debate, and then go over some areas of opportunity that we're seeing as the fixed income markets have become more interesting over the last 10 years. So I will turn it over to Ken. And a few housekeeping items. The recording of this presentation will be sent out probably a week from now after it goes through compliance review. You will all get a copy of the slides, even if you weren't able to attend today. And if you registered, that's what's going to trigger it for you to get it in your email. And if you have any questions throughout the presentation, please use the chat button on the bottom of the Zoom window, and we will try to address all those questions towards the end of his prepared remarks. Ken, I'll turn it over to you. Thank you.
Awesome, Brian. Thank you so much for having me and really for having that partnership with PIMCO in this regard. We're really excited to talk about the fixed income landscape, the marketplace. I'll kind of center my comments really on three things. One, I do want to touch on the opportunity set, fixed income. You've probably been following CNBC, Wall Street Journal, what have you, and there's been various points where the attractiveness of the fixed income market is certainly at play. Also, a lot of questions around what's driving the fixed income market, the treasury market, and what's happening from a macro perspective. So I want to make sure we address some of that. I'm going to also share PIMCO's latest outlook. PIMCO, we're an active manager, meaning we're going to be moving portfolios around, trying to hedge out certain risks, but then also integrate certain ideas that we think are going to be more attractive on a forward looking. And so I'll touch a little bit upon what some of those macro themes are from a GDP, inflation, different growth dynamics on a US, but also global basis, and then how that's translating to markets and the opportunity set between fixed income and equities, I think is really, really interesting today. And then last, I'm going to touch on basically the global marketplace. There's some somewhat shifts going on today where things outside the US are starting to look more and more attractive. And so how do we, as an active manager, take advantage of that? Again, integrate those ideas. And so I want to make sure we touch on that. I am going to share a set of slides. And so just to maybe frame some of the conversation. So I'm going to share my screen right now. And you all should be able to see that now, and we'll get going. Okay. First and foremost, you probably have heard from different market participants, different media outlets on the attractiveness of fixed income. This is really on the back of some really challenging years a couple of years ago, back in 2022, notably when interest rates moved from basically the lower end, almost zero bound range where the Fed had their policy rate, to a much more elevated level. That is very challenging in a short-term time period if you're a fixed income holder, because as rates go higher, bond prices go lower. The really nice thing with fixed income is bonds are basically contractual. You get your interest, you get your principal. And while you might have mark-to-market fluctuations, the passage of time heals those challenging periods in the sense of, as I get more cash flow interest payments, I reinvest those coupons. As I get maturity payments, I reinvest those that principal. And so the recovery component that you have in fixed income, because it's so contractual, as long as you don't have a default, you're all good. Very different than the equity world, where if you think about, you basically need earnings growth, valuations to really support overall levels of return. And so what that has meant today, because we've had this reset higher in yields, you look across the fixed income landscape, and what we have here is basically a couple indices at the top. So the global ag, this is like the big bond market indice that a lot of people will run their portfolios against from a benchmark perspective. The starting level of yield today is right around 5%. You'll see in a couple of slides, starting level of yield is a very good predictor of forward-looking return. But if my index is 5, PIMCO, we're going to actively manage the portfolio, integrate the things we like, not invest in the things that we don't like. And so you tend to have what we call a yield advantage by doing that active management and thoughtful portfolio construction. And so today, the starting level of yield for things like a high quality core plus, things like our BOND ETF or our income-oriented portfolios, we're oftentimes talking about a yield in the 6 to 7% world. If you think about historically, like equity, you typically pencil in 7 to 8% estimated return on any given year. Right now, we're penciling in 6 to 7% for your high quality fixed income. And so that has caused a lot of allocators and investors to somewhat favor the fixed income world relative to equities. I'm not saying that you should not invest in equities. It's just when you think about those classic like 60-40, 70-30, what have you, right now, the marginal dollar, just at least on a forward-looking return perspective, a lot of that is suggesting things should tilt a little bit more towards the fixed income side of the ledger compared to equities, simply because valuations are somewhat stretched. It is nuanced, and I'm going to touch on the nuance here in the next couple of slides. But you have this situation in which valuations are tight within fixed income worlds. They're also tight within the fixed income credit landscape. So at the bottom here, you can see investment grade credit, high yield credit, EM. And you notice the spread is pretty less attractive relative to where we've been in the past. And that's because a lot of money's been chasing these bonds. And so when you have more demand, less supply, the way the market clears is you essentially have a bit of a tighter spread. We overcome that in a lot of ways because we focus on relative value. And so the things that we've been investing a lot more in these days are agency mortgages, AAA securitized assets, where that spread level is right in the middle of the page and much more attractive right now compared to where we've been in the last 10 years. Okay. One of the things that you'll hear from a fixed income person oftentimes is, what's the yield? Why should I focus on the yield? And why is it so important? There's a couple of things going on this slide, and so I want to make sure I clear it thoughtfully. On the left-hand side, this is really what an investor's return profile has been ever since rates reset higher following the calendar year 2022. And that's really when PIMCO, as well as most fixed income managers, basically started to really pound the table to say, hey, bonds are really attractive at these levels of yield, because when you're earning your interest, right, it's basically you're getting paid to invest in the asset class. And so what you see in the blue there on the far left-hand side of the page, that shows you basically, hey, if I just invest passively in the big US Ag index, I've basically earned 5%. In the green, which is in the middle, that's a total return oriented portfolio where we're going to actively manage it at PIMCO. BOND is our ETF version of this asset class. You can see that green diamond is higher, but even just the range of what the returns have been has also been higher than what you've earned on the ag. That's going to get to the active management in terms of what we're doing to integrate different ideas that we like and essentially position portfolios for the forward looking. And then there's other strategies like our income portfolio, where the flexibility to basically really integrate some of those high conviction ideas, size and scale those up to a little bit larger degree, that's actually really worked out well. And that's where you see the average return has been right around 7-8% for the portfolio. And then again, on the forward looking is what you see on the right-hand side. Basically, today's starting level of yield for the index is right around 5%. The yield on many of our high quality core fixed income portfolios is around 6%. And so it's a pretty good predictor. The correlation is 93%. So meaning they track each other really, really closely, that starting level of yield to that forward looking return. And so that's something that we do think investors in fixed income can count on. Another thing that we think that investors can count on, and this has really come into question more recently, is this idea of the stock bond correlation, right? We tend to think about really diversified portfolios because if one thing is going down, I want to make sure that there's something else in the portfolio that's likely to go up. And so we balance out the risk profile. Historically speaking, that has been the balance between stocks and bonds. That has come into question simply because when you look at the calendar year 2022, when you look at different episodes, people have said, whoa, 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 stocks are going down and the bonds are going down. Like something must be broken. And some of that has to do with overall levels of debt and overall levels of inflation and where we're at. And so what we try to show on the right-hand side of this slide is busy. I totally admit this. But what it's really trying to distill is when inflation is elevated, like we've been following the pandemic, that stock bond correlation, which is typically negative, meaning as stocks go down, my bonds go up, it's flipped to be positive because the market's been trying to address and deal with more elevated levels of inflation. But the good thing, and really what is starting to come back, is now that inflation is trending closer to the Federal Reserve's target, right? They target 2%. We're getting much closer to those levels. You're actually seeing the asset class trade on a daily basis with that traditional negative correlation. So when stocks go down, bond prices are increasing because the expectation that the Fed's going to start to lower rates, which is really getting priced into the market, a lot of that is likely to come to fruition. So that's good. The other good thing is when you look at these different isolated incidences, even though we've been elevated on an inflation perspective, when you've had these scares, so on the left-hand side, right, Silicon Valley Bank, no longer with us. You had this Japan carry unwind trade. If you follow CNBC, they loved to cover this back in August last year. It was something related a lot more towards hedge funds, but it impacted the overall market. And even earlier this year, when you had a lot of trade war concerns, growth scares, it resulted in basically equities declining, and each one of those isolated incidents, you saw bonds rally, bonds outperformed. And so that diversification benefit that you tend to think about for fixed income, it truly is coming back, and it's something that we think investors can count on along with that really attractive level of yield. One thing that I think is important, and this has really come into question from an asset allocator's perspective, is how can we be sure that fixed income is going to outperform equities, and how has that worked in the past? This basically shows you each one of those gray periods coincides with a recession. Now, PIMCO is not necessarily calling for a recession to happen in the next 6 to 12 months, but if we think over a longer term time period, it is certainly possible, some might say likely, that we're going to experience a recession sometime in the next 2, 3, 4, 5 years. And so when we think about the asset allocation shift, the blue bars at the top there basically highlight the periods where treasuries and fixed income outperform equities. 8 out of the last 9 recessionary periods, you've seen fixed income outperforming equities. And so you tend to think about when you're allocating, hey, I want to buy something that has a really attractive level of yield. I want to be compensated. I also want to buy something that tends to be resilient and robust, especially in downturns, because right now, valuations, the market are somewhat stretched at a time when there's a lot of disruption happening, whether that's AI related, could be government spending related, trade war uncertainties. And so it gets back to this idea of the safety net is certainly there for fixed income. It's not as there in a more pronounced fashion as it is on the equity side. And so that's why you see a lot of people focused on building this diversification, having maybe a little bit more fixed income today because I can count on my yield. And this thing also does well when you have growth surprises to the downside, which is certainly potentially in the cards, especially if the administration isn't able to thread the needle on some of the growth perspectives on a forward looking. Okay, one thing that before we talk a little bit about the outlook and just what's driving the market, I did want to touch on this idea of an active manager versus a passive manager. Brian mentioned this. I went to U Chicago, and I think that's one of the schools that has one of the leading research components related to this. And we talk oftentimes about like efficient markets. And you'll hear this idea that markets are fairly efficient. And we would 100% agree on the equity side, meaning the level of information, the ability to mirror or mimic what's going on in the stock market is fairly, and easy for a fixed income person to say this, but fairly easy to do. Because if you tell me, hey, go match the S&P 500 returns, so it's like, well, I know what stocks I need to buy, I know the weighting of these things, and I can rebalance fairly frequently at almost no cost now. That transaction costs are basically out of the window. And so basically getting some of these very efficient exposures to large cap stocks, to foreign stocks, is somewhat easy to do. Now, I'm not saying that there's no ability for active managers and equities to outperform. On average, and this is what you see in the green there, on average, most of those active managers, they actually don't outperform the passive managers. But in fixed income, it's a very different story. And that's what you see on the left-hand side is really an ability, notably in core and core plus, right? So some of the flagship-oriented fixed income portfolios that PIMCO runs. And this is because when you think about, I mentioned like the S&P 500 has roughly 500 stocks in it. If I think about the ag index, there's about 15,000 securities in that index. They're comprised of treasuries, U.S. treasuries, agency mortgages, and investment grade corporate bonds. When we're building portfolios, right, to go out and buy 15,000 securities in a very efficient manner, no way, can't do that. So there's always going to be some sampling that's done by passive managers. What we do on the fixed income side on an active basis is we basically look at the marketplace and we find the securities that we like. Treasuries, agency mortgages, investment grade corporates, and we build the portfolio really from the bottom up in a bond by bond basis. The other thing that happens a lot within fixed income markets is the market participants are not always trying to buy low and sell high. You have essentially what we call a non-economic buyer, very present and prevalent in this marketplace. They take the form of central banks, the Federal Reserve, right? During COVID, following the financial crisis in 2008, they were very active in terms of buying bonds, and they're now sitting on the Fed's balance sheet. They bought treasuries, they bought agency, so Fannie, Freddie, Ginnie mortgages. They also bought corporate bonds for the first time following the pandemic. You'll hear PIMCO and others say things like, oh, I want to buy this before the Fed buys. And so that was a really good strategy back then. We also have things like pension funds, where they're trying to match a liability. And so this causes distortions across the yield curve. And it's a way for us as an active manager to move the portfolio around to ultimately hedge certain risks, but really benefit end investors. And the way that that benefit comes is basically outperformance, an ability to outperform our benchmark, and importantly, outperform the passive alternatives, right? Because when you're an investor, you basically can buy a passive strategy or you could buy an active strategy. And the reason why you should care about the difference and being able to outperform and out earn has to do with the fact of just compounding excess return, compounding interest. And 50 to 100 basis points, which we tend to outperform passive by about 100 basis points, that extra 1% on top of it, year after year after year, really starts to grow. And it's really, really important, especially as you think about pulling down on those assets in retirement later on. Okay, I'm going to touch a little bit on PIMCO's backdrop, and I'll do this fairly quickly. So we care about 2 time horizons at PIMCO. One of them is like the 6 to 12 months, what's likely to happen from a growth, inflation, and a policy perspective, things like monetary policy, Federal Reserve, but then also fiscal policy, what's going to come out of the government and how that is going to influence markets. And then, then we care about a lot about what we call the secular time horizon. That's the 3 to 5 year. I find it really interesting because what you see on the page here is a lot of our secular long run themes. they're very applicable in the short run. And you see them playing out actually in markets quite a bit. And so this idea of like a multipolar world and really calling into question if the dollar is going to continue to be the reserve currency. The short answer is we absolutely believe that the dollar will continue to be the reserve currency of the world. Nothing's changing on that front, although the fact that we're having the conversation should cause maybe just a little bit of pause. And the reason why we don't see anything shifting there is there's really no good alternative. You'll often hear us say things like, well, it's the cleanest dirty shirt, right? If I look at every other currency out there, and if I look at crypto or stable coins, there's problems with each of one of them. The dollar is the current reserve currency, which benefits Americans or US-based investors quite a bit because of just the prevalent and frequent use of dollars and investment in things like treasuries. There could be a world very far in the future where there is something different, and that could cause quite a bit of disruption, but that's not something that we see in the next 3 to 5 years. What is causing a little bit more concern is rising debt levels. PIMCO, we've written about this for the last couple of years and just saying that the trajectory of the US debt and really deficit is not in a great direction. And this is where something will need to be addressed over the next 3 to 5 years. You've already seen the US government get downgraded by every one of the rating agencies. And so the storm clouds are building. It's still a situation, though, where when we run into these challenged market episodes, everyone goes and buys treasuries. And so there's still that safe haven component, but certainly something that we need to think about over the long run and get our fiscal house in order, at least from a US citizen perspective. The last thing is a lot of this is coming in the form of volatility in the market. As uncomfortable as this is, volatility is actually really like an active manager's playground, right? We try to provide liquidity to the market when we think it's an attractive opportunity to buy. And then when things get back to normal, we'll sell those securities. And so volatility, it creates opportunity. It is an interesting world because right now it's like you typically would see an economy dictate politics and policy. Things have reversed where politics are dictating policy, which is now influencing economies. And so there is a bit of a reordering, which creates a lot of volatility. For us, that creates a lot of diversification opportunities and a way for us to use our active management. One thing that I'm going to hit on a couple of slides, and then I do want to touch on the global opportunity set before we open up questions. I mentioned this idea of like why the dollar is not going to lose its reserve currency. A lot of it has to do with its prevalent usage in a lot of different markets. So in terms of like FX transactions, anyone that's been traveling more recently out of the country, when you go and you exchange currencies, right, you're exchanging dollars for name the foreign currency. That continues to be very prevalent in FX markets, not just when American citizens are going out. Most people have their currency pegged to the dollar, and so that's an important component backstopping the usage. Oil markets, commodity markets, invoicing across countries, a lot of that is still done in dollars in a very high frequency. So to switch to some other currency at this point, there's nothing, again, there's no alternative out there to support this at this time. So it's somewhat of a carry on with the dollar. This is going to be an interesting chart for those that kind of are following the debt and deficit challenges that the US is kind of headed on. We'll oftentimes look at things on a debt to GDP ratio, right? How's my debt relative to the GDP? And what you learn in business school in different areas is like, there's no magic number, right? We can point out places like Japan and you're like, well, I don't want to be like that. But then when I look at emerging market countries, they don't have a lot of debt. And so it's like, well, maybe that's not perfect either. What is really the concerning component is the trajectory of some of these things, like the US, which is in the middle of the page here. Some might actually say Japan has gotten their house in order, and the fact that they're leveling off, that's kind of a good thing. And so this is what's caused us to highlight this as a potential concern, because if you have too much debt, it really reduces the options to address when you have these economic shocks. Think back to COVID, think back to the global financial crisis. That was a time where the monetary policy, the Fed was able to open up their balance sheet, buy a bunch of bonds. The government was able to go out and do a bunch of spending programs. In a world where we have too much debt, it really reduces your ability for the Fed or for the government to step in and really start to bridge these to build these bridges to get us to the other side. And so these are some of the things that are getting called into question, and why, whether we're talking about the potential bill that's up on Capitol Hill right now, or just in general, you're seeing some challenges as it relates to the overall debt levels. One last chart. The reason why so many are focused on basically the trade policies is it does create this dynamic where you go back in time and it's like, well, we've been here before, but as you can see on this chart, we really haven't been here for like the last 60 or 70 years. And so this like reordering and this idea of like, what's trade going to ultimately look like and how will that influence growth? A lot of that stuff is being called into question. And so this creates a lot of uncertainty. Uncertainty usually manifests in the way of volatility. And that's why you see the market reacting in a fairly not so benign way like it has in the past to different announcements. I said last chart, one more here on the market, and then I did want to touch them on the global opportunity set real quick. There is a lot of room for the Federal Reserve to cut rates. This is the safety net. So this shows historically where we've been, but you can see how much rates went up in 2022. That was in response to elevated levels of inflation. It is very likely that in a year from now, you're going to see the Fed policy rate be lower, and you're going to see both that blue line and that green line lower than they are today. That is why the yield curve is no longer as inverted as it was in the past. If I look at things like the 2-year Treasury versus the 30-year Treasury, we're now talking about a difference between 4% and 5%. There is 100 basis points, so a full 1%. It wasn't that long ago that you basically had flatness across the entire yield curve. Remember, yield curves are supposed to be upward sloping. When we lend money for 30 years versus 10, we should get investors more return, right? There's a lot of things that could go bad between years 10 and 30. And so when we think about things like term premium, a lot of those more traditional market dynamics, they're coming back today. Okay, one other market dynamic that is fully at play is the global opportunity set. What you see on the right-hand side is the size of the US market versus the rest of the world. And you can see the US, it absolutely is the largest. But when I start to stack on Europe, developed market outside of Europe, places like Australia, New Zealand, other areas that we'll frequent in, and then emerging markets, there's actually a huge like supermarket of bonds that we will shop down different aisles. And oh, by the way, many of those are looking really attractive today also from a yield perspective. And what you see on the left-hand side is when you start to introduce global opportunity sets, your return goes higher and your volatility decreases. This is like textbook definition of the free lunch that you get with diversification. Historically, very busy chart right here. It's just the idea of like the US bond market is in blue. Go year by year. It's usually another country that's going to have a higher, more attractive return relative to the US. The reason why we like non-US bonds today is what you see here. Basically, more attractive levels of return yield in those developed market countries. And then when we start to look at emerging market opportunities, that gets really, really attractive. Last slide for me, and then we're going to open it up for questions. This is ultimately what we're trying to do. So this is our BOND portfolio. The yield is right there in the middle, and the different colors shows you where we're getting the yield from. We are managing to outperform the Bloomberg US aggregate. The yield on that is right around 5%, 475. The yield on our portfolio, the BOND portfolio, it's really close to 6%. It's about 580 right now. The first takeaway that you should have is we have a yield advantage, and that yield we are earning on a monthly basis, and that is kind of the foundation for outperforming the index. The other thing that you should take away is we're much more diversified, right? When you look at the ag, it's basically three things: treasuries, agency mortgages, and investment grade corporates. We got a lot of different colors, meaning we have a lot of different exposures that are going to be sized and scaled based upon our active ideas. And this tends to lead to alpha, so outperforming our index, but also really nice diversification if you enter periods of market stress. And that's an environment where it's certainly possible. It's not our base case that we head into a recession, but something that's very, very diversified, that's very high quality like this, that, oh, by the way, has a yield advantage, we think is going to do really, really well on the forward looking. So that's what we're thinking about, right? Really attractiveness on fixed income, starting levels of yield, active advantage in terms of building portfolios, but importantly, an interesting environment from the macro perspective as we think about, what's going to happen both from Washington as well as other governments as it relates to trade policy, and then how that's going to manifest in terms of both growth and inflation. All right, Brian, maybe it's a good opportunity to go for questions. Oh, Brian, I think you're still on mute.
Classic Zoom mistake. Yeah, it took me a little bit of time to come out of the back room to get up there. So anyway, thank you for those comments. If anybody has any questions on this virtual event, please use the chat feature in the bottom of the Zoom bar and post your question and we'll ask it. I have some initial lead-ins. So on the last slide that you covered, I'm going to kind of go in reverse and get some questions going here. So I noticed the agency mortgages thing item on what you are doing in bond. And for most of our clients, we do have some level of mortgage bond opportunity or income fund used in their portfolios. Talk about the agency mortgage opportunity, because that's something that came about within the last couple of years. We took advantage of it with you. But why did it exist, and what exactly is the theme that you all are looking for out of that area of the market?
So this is, I think, one of the classic examples of why active management matters so much. If we think about agency mortgages, and so these are Fannie, Freddie, Ginnie Mae. More recently, you've seen Fannie and Freddie come into consideration around things like privatization. These assets have been part of the Federal Reserve's toolkit. So during the financial crisis and during COVID, when the Federal Reserve is building that safety net, what did they do? They bought treasuries and they bought mortgages. And the reason why they do that is they're trying to basically bring down interest rates, and they're trying to bring down risk so that people go buy mortgages and they start investing in these things. And so by bringing the rate down, they make affordability much better. What that happens from a market perspective, as they're an indiscriminate buyer, right? The Fed's just buying these things. They cause the yield to go down and they cause the price to go high. So that I mentioned that idea of, hey, we want to buy things before the Fed buys them. That's what we were doing basically during the pandemic. And then once the Fed got enough of them, we moved out of that asset class because prices were basically at all-time highs. The reason why we've been buying, and so we reduced our exposure quite a bit. In things like BOND, where we're looking to outperform the index, we had less exposure. In things like income fund, we had way less exposure than we had in the past. The reason why we've increased our exposure here is rates went high. So the asset starts to look really, really attractive. We start to look around for what we would call more resilient assets versus another. Resilient being the fact that the Fannie, Freddie, Ginnie, there's still a government guarantee associated with it. And so if we were to stumble across hard times again, it is very likely that those assets would be, again, purchased by the Fed. And so you have that safety net kind of built in. They're also the second most liquid asset behind treasuries. And so as an active manager, when we're trying to find something that has an attractive level of yield, we want to look at like downside risk scenarios. The worst thing and what we always want to guard against is, oh my gosh, the market's selling off. That's a great time to go buy things. The only way that you can go buy things is if your portfolio is liquid in your own right. And so agency mortgages, they're the second most liquid asset behind treasuries. And so having a higher allocation to that today at a time where we're being compensated for the spread component, it kind of checks the box, especially relative to corporate credit. And anyone that has recently gotten a new mortgage, we're talking about mortgage rates in like the 6-7% range. And so we're somewhat, as an investor, enjoying 6 to 7%, knowing that those borrowers are going to refinance. And so when that refinances out, we'll go buy other things. But right now, we get to enjoy a pretty attractive level of yield and return right now.
Great, thank you. This one's more of a layup. This is just the world that you and I traffic in. But for our audience, you mentioned 15,000 issues that are in the benchmark or the Bloomberg Aggregate Index that is used commonly for benchmarking a fixed income portfolio. How are they weighted? Meaning, how is that index constructed?
It's a great question because it's evolved significantly over the last 10 to 15 years. And so the risk profile of the index, and then consequently the risk profile of a passive strategy has also evolved. If I just look at so historically speaking, and when I say historically, like if I go back 20 years, the index, it used to be basically chopped up in thirds. 1/3 was treasuries, 1/3 was agency mortgages, 1/3 was investment grade credit. And the reason why this is the so widely adopted index is like those are pretty well diversified. I got treasury exposure, I got mortgages, I've got corporate credit. It's a pretty good index, right? Well, a lot has happened over the last 15, 20 years, notably issuance by treasury, US treasuries. US treasuries now represent about 45% of that index. Agency mortgages, a lot of people bought mortgages following the 2008 crisis. A lot of people refinanced also during COVID. And so that amounts to about 30%. And then the remainder is corporate credit. Corporate credit tends to be the highest yielding portion of the index. And so today versus previously, I've got more treasuries, I've got more mortgages, and I got less corporate credit, which has less. So I've got less yield, I've got less spread. At the same time, I have higher interest rate risk, higher duration, higher sensitivity to changes in interest rates. And so for those that are passively trying to invest, you can kind of look at your product to say, wow, I've got more interest rate risk, I've got more linkages to the US government, and I'm not getting compensated as much. I got lower levels of yield. That doesn't always feel that great. And that what we do from an active management standpoint, right, we're going to build the portfolio overweight, underweighting asset classes that we like, but then we're also going to think about how much interest rate risk do we feel like is appropriate for a portfolio? Because as we've seen more recently, there's been a lot of interest rate volatility in the market. And so hedging that risk is something that we care a lot about.
Yeah, the interest rate volatility feels like a roller coaster, especially when you just look at a 10-year bond at this point in time.
Absolutely.
So I'm going to pull on that thread a little bit further. So with the construction of the index, the reason, and you can talk a little bit more to it, but predominantly when people think of indexing or passively investing, a very easy thing to think of is like an S&P 500 index fund on the US equity side. Alternatively, when you flip that over to the fixed income world or the bond world, an S&P 500 fund, if you think about the constituents, the companies that start making up a larger proportion of that index are doing so because the valuation of those companies is growing.
Yeah.
On the fixed income side, it's a little bit counterintuitive because the more debt you issue, the bigger component of the index you become. So the more indebted you get, the bigger you become, which is like the opposite of what the equity market is trying to do. So, oh, go ahead.
No, you're getting on a very important point, and it's why we're starting to maybe ring the bell a little bit to say like the debt and deficit trajectory of the U.S. government is it will eventually need to be called into question, because you're 100% correct. The more debt that they issue, the government, the bigger portion of the index they become. And then another important point is like when I think about like JP Morgan, name the financial, Wells Fargo, they're going to have like 75 bonds, all with different maturities across the yield curve. Some are going to be 2 years, some are going to be 5 years, some are going to be 10 year. And so this idea of like, when we're investing as an active manager, we want to make sure that the institutions are going to be a going concern. One, right? Are the debt and deficit trajectory more challenged? Like, look what's happened with the US government. Now that they've been downgraded by every rating agency, the compensation, the risk premium has been going higher, right? Investors are going to demand more. The same thing goes with those major corporations. If they're issuing too much debt, it can be a good thing so long as the growth materializes on the back end. But if it doesn't materialize on the back end, think about it in a consumer's perspective. If I've got a big house and I'm sending my kids to private school and I've got a bunch of cars, everything's great so long as my income can support that. But if my income can't support that, that's when we have a real challenge. And so we're not saying that we're there yet, but with the US government, but you're starting to see like, hey, there's some really question marks that need to be addressed over the next 5 to 10 years.
And then before we wrap up, because we're almost at the 45-minute mark, I had one other, because in the world of fixed income, a lot of people are used to hearing about mutual fund versus exchange traded fund on the stock side of the equation because of tax efficiency, meaning ETFs are a lot more tax efficient than mutual funds. Talk about it on the fixed income side, because it is different.
So it is different. There's similarities and there's differences. There are tax efficiencies related to ETFs, and some of that is due to the trading dynamics in terms of how we're able to push bonds or take in bonds. And so how you think about it in an equity context, there are some similarities, is that there are true tax advantages. There's also, I tend to think of it as the ecosystem that ETFs live in, with different broker dealers, market makers. We manage, obviously, mutual funds, ETFs. We manage separate accounts for institutional and retail clients. And on mutual funds, we get the flow from the investor, whether it's an inflow or an outflow. We see that every day, which is great because we're going to put money to work, either raise liquidity or we're going to get invested every day, which makes us a repeat customer. And so, right, the street dealers, they work really, really closely with us. On the ETF side, a lot of that stuff is housed by the market makers. And so we're not always getting new flows or we're getting outflows. Like, a lot of that is basically housed. And why that matters from an investor standpoint is we can stay fully invested at all times. And I think back to, this idea that we all want to be tactical. It's really important to like remain in the market and just think about shifting portfolios more than anything else at times. And so the ETF vehicle, it allows for some of that tax efficiency to still be at play, but it allows us to stay fully vested and not have to worry about wild swings as some people are pulling money out and others are putting market money in. It's a bit of a more consistent asset class in that regard.
Thank you. So it doesn't look like we have any other questions at this point, and we're right at the 45-minute mark. So I wanted to say thank you. Appreciate you doing this today and spending the 45 minutes with us and our clients. Thank you, Ken. Appreciate PIMCO, and I appreciate what you have done to help add value to client portfolios. So thank you. And for everybody on the call that's still here, you will get a copy, in case you joined late, you will get a copy of this webinar and also a copy of the slides that Ken covered today. So thanks for joining. Appreciate it. Have a good rest of your day.
Thanks all. Have a good day.
All right, take care.